Welcome to the deep dive. Today we're tackling a story from the financial world that honestly, it almost sounds made up. Get this. A firm, less than 200 people, right? In 1996, they pulled in a profit of $2.1 billion.
Yeah, billion with a B.
Exactly. And just to give you some scale, that same year, McDonald's made, what, $1.6 billion? Disney, $1.2 billion. Even Warren Buffett's Berkshire Hathaway booked about $1.5 billion.
And the wild part is this firm, long-term capital management, LTCM, they'd only really been going for 2 years at that point, started in 94.
Incredible speed. But here's the twist. It's a big one. Just 2 years after that peak, September 1998 rolls around and bam, everything implodes.
Completely. Investors, the partners themselves, they lost almost everything, and it nearly took Wall Street down with it.
It really is that Icarus story from Greek mythology, isn't it? Flying so high.
And then straight into the sun. Catastrophic fall.
So that's our deep dive today. We're digging into the fascinating and pretty sobering lessons from Roger Lowenstein's fantastic book, When Genius Failed. We'll track how LTCM exploded onto the scene and then how it all unraveled so spectacularly. There are some really profound takeaways here.
Absolutely. About risk, about markets, about, well, people.
Okay, so let's unpack it. To really get LTCM, you have to start with the founder, John Meriwether, University of Chicago MBA.
Right. And before LTCM, he'd run the fixed income arbitrage group at Salomon Brothers. Hugely profitable group.
Yeah, they were basically wizards at finding tiny price differences in bonds, that sort of thing. And his team, they were different, weren't they? Very scientific.
Oh, definitely. All about the numbers, the models, not gut feeling. They were famously known for calculating odds on pretty much everything. Even played liar's poker, you know, that Wall Street bluffing game.
Just to see who paid for dinner. Tells you something about the mindset.
It really does.
So Meriwether leaves Salomon in 91. There was that scandal involving a subordinate making illegal treasury bids. Meriwether wasn't directly involved in the wrongdoing, but the firm asked him to resign. Loyalty cost him there, perhaps.
Seems like it. And then fast forward to 1994, he launches LTCM. Ready for redemption, aiming to do what he did at Salomon, but, you know, bigger and better.
And the team he put together, I mean, wow.
Seriously, it wasn't just a team. People called it the dream team. You had Lawrence Hillenbrand, MIT double degrees, a real trading star.
And then the academics?
Right. 2 Nobel Prize winners. Robert Merton from Harvard, a math professor, and Myron Scholes. Yes, that Myron Scholes from the Black-Scholes options pricing model.
The formula that basically changed finance.
The very one. Plus, Victor Hergani, David Mullins, who had been vice chair at the Fed. I mean, the intellectual firepower was just off the charts.
So with that kind of brain trust, raising money must have been easier.
Easier is an understatement. They raised $1.25 billion in startup capital, which back then was just unheard of. The largest startup amount ever at that point.
Okay, $1.25 billion Nobel laureates. How did that translate into actual results? Early on, I mean.
Explosive results.
Right.
Right out of the gate. In 94, their first real year, they returned 28%. The S&P 500 did 1.3%.
Wow.
Then 95, 59% before fees, 59. And 96 was 56%. That's the year they hit that $2.1 billion profit figure we talked about.
Just staggering numbers. And I bet the partners did all right for themselves with the fees.
Oh, yeah. Very aggressive structure. 2% of the capital managed and then 25% of the profit. So the founders got incredibly wealthy very quickly.
You see that kind of success, especially with people who are already, let's say, intellectually confident.
Yeah.
Hubris has got to creep in.
Absolutely. It was palpable. People who knew them from Salomon said even back then, these guys didn't breathe the air that everybody else did. They felt separate, superior.
Yeah. And that only got worse at LTCM.
It seems so. Your story is like one partner lecturing a friend who actually had a PhD in economics, and almost all the partners doubled down. They borrowed money personally to invest even more into their own fund.
Which was already super leveraged.
Exactly. It just shows this absolute conviction that they couldn't possibly lose.
So, okay, they're riding high, but then those easy arbitrage trades, the bond stuff, it started to dry up a bit.
Yeah, by 1997, the really obvious opportunities in their main strategy, bond arbitrage, were getting harder to find. Spreads were tighter.
So what did they do? Did they adapt?
They did, but maybe not in the way you'd hope. They started moving into areas that weren't really their core expertise. Things like merger arbitrage. We talk more about that later.
Okay, stepping outside their comfort zone. How did that work out in 97?
Surprisingly, still pretty well. They managed a 25% return that year, and they did something really unusual. They actually gave back capital to investors. $2.7 billion.
Gave money back. Why?
Their reasoning was they had too much capital for the available opportunities, which, looking back, was maybe a blessing in disguise for those investors who got some money out. A godsend, as Lowenstein puts it.
A godsend indeed, because 1998 was just around the corner.
Right. And that's when things went south, fast. You know, the East Asian financial crisis still rumbling, and then Russia defaulted on its debt in August 98. Global markets went haywire.
And LTCM
got hammered. They lost 45% of their equity in 1 month. August 98.
45%. How did the partners react? I mean, the geniuses.
Reports say they were genuinely confused, baffled. Their models were saying the markets were moving irrationally. They couldn't quite grasp that maybe, just maybe, their models weren't capturing reality anymore.
The models were wrong, not the market.
Pretty much. But admitting that is hard when your whole identity is built on those models.
So the situation, it's desperate. We're talking, what, over $100 billion in liabilities on their books?
Huge liabilities. Their equity was evaporating. And the big Wall Street banks, who were lending them all this money, started getting really nervous. This wasn't just about LTCM anymore. It could ripple through the whole system.
And then enters Warren Buffett, sees an opportunity.
Classic Buffett. He, along with Goldman Sachs and AIG, made an offer, $250 million for the entire firm.
$250 million for a firm that was worth, what, $4.7 billion just months before? And earned $2.1 billion in 96. That's brutal.
Absolutely brutal. And the story goes Meriwether was given just an hour to say yes or no.
An hour.
Yep. He couldn't pull the trigger, couldn't accept how far they'd fallen, maybe.
Yeah.
The hour passed, the offer vanished.
Wow. So what happened then? No buyer.
The Federal Reserve had to step in. They were deeply concerned about systemic risk, the domino effect if LTCM collapsed completely. So on September 23, 1998, the Fed orchestrated a bailout. Basically, strong-armed 14 major banks into injecting capital to stabilize the fund.
A bailout to save Wall Street from LTCM.
Essentially, yes. But for the original investors, devastation. If you'd put $1 in back in 1994, it was worth $4.11 by April 98. 5 months later, it was worth 33 cents.
Ouch.
And the partners themselves wiped out completely,
Yeah.
leading to those headlines.
The brightest and the brokest. That really says it all, doesn't it?
It captures the sheer magnitude of the fall.
Okay, so the brightest and the brokest. It just leaves you asking, how? How does a firm with that much brain power blow up so spectacularly?
Well, one huge piece of the puzzle, maybe the biggest, was this lethal mix they created. Extreme leverage combined with investing in things that were hard to sell quickly. Illiquid assets.
The deadly cocktail.
Exactly. Think of it like building a fancy cocktail bar, but you decide to soak the floor in gasoline. And the bartenders are juggling flaming absinthe shots. Oh, and the only emergency exit? It's locked.
Okay, yeah, that paints a picture. Something's bound to go wrong.
Right. LTCM was operating with like 20 to 30 times more borrowed money than their own capital. Insane leverage.
20 to 30 times, so those huge returns we mentioned.
Were massively amplified by the leverage. That 59% return on equity in 1995, if you looked at their return on total assets, including all the borrowed money, it's only about 2.45%, much less impressive.
So the leverage was doing all the heavy lifting, but why did they think they could handle that much?
Their big assumption, and it was a faulty one, was that their main trades involved such tiny price movements, tiny spreads, that even with huge leverage, the overall risk wasn't that different from just, say, owning stocks.
Which turned out to be wrong.
Dangerously wrong. And then there was the second part of the cocktail, illiquidity. LTCM wasn't just making these trades, they were making them in enormous size. They were the market in some of these specific assets.
Ah, so when things went bad in August and September 98,
They couldn't get out. They tried to sell positions to raise cash, meet margin calls, but they were too big. Selling would just crash the price further against them. They were trapped.
it's like that John Maynard Keynes quote, isn't it?
Precisely. Markets can remain irrational longer than you can remain solvent. LTCM ran out of solvency before the market corrected in their favor.
So the lesson there seems crystal clear. You can use leverage, maybe. You can hold illiquid stuff, maybe. But mix high leverage with illiquidity.
It's a recipe for disaster. Because liquidity, the ability to sell easily, always seems to disappear right when you desperately need it most. Always.
Okay, leverage and illiquidity, that's one toxic mix. But still, these were brilliant people, Nobel laureates in finance. How did their models, their core intellectual framework, fail so badly?
That's maybe the most fascinating part. There were at least two really critical, flawed assumptions baked into their mathematics. First, they assumed market price changes basically followed a normal distribution. The classic bell curve.
Like height or exam scores, things like that.
Exactly. Lots of things in life follow a bell curve. But market returns, not so much. They have what people call fat tails.
Fat tails, meaning?
Meaning extreme events, the really big up or down swings, happen way more often than a normal bell curve would predict. Eugene Fama, who was actually Myron Scholes' thesis advisor, showed this years earlier. He found that statistically these massive 5 sigma events, things that should only happen like once every 7,000 years according to the bell curve,
Yeah.
they actually happen every 3 or 4 years in real markets.
Whoa. Okay, so their model drastically underestimated the chance of a huge loss.
Hugely. It's one reason Seth Klarman, the famous value investor, looked at LTCM and apparently said, "No thanks." He saw the flaw. It's like our bar analogy again. LTCM's models were great at predicting how people behave normally in the bar, but useless for predicting how they behave when the place is on fire. Panic changes everything.
So that's assumption number one. What was the second big flaw?
They thought they understood exactly how all their thousands of different positions were correlated or interconnected. They assumed that not everything could possibly go wrong at the same time. Diversification, right?
Makes sense. Don't
Yeah.
put all your eggs in one basket.
Sure. But in a real market crisis, diversification often fails. It's not like rolling dice, where each roll is independent. In a crash, almost everything goes down together. It's not thousands of companies suddenly having bad news simultaneously. It's investor psychology. Fear takes over. Herd behavior.
So their different baskets all broke at the same time.
Pretty much. The correlations they assumed just didn't hold up under stress. Everything went against them at once.
And these flawed assumptions, they must have given them a dangerous sense of, like, false precision.
Absolutely. A totally false sense of certainty. After their first year, Merton and Scholes calculated the odds. They predicted the fund would only lose 5% or more in about 12 years out of every 100.
Okay.
But that massive loss in August '98, according to their models, an event that extreme was so unlikely it shouldn't happen once even in a lifetime of the universe.
Lifetime of the universe series.
It's the quote Lowenstein uses, and yet it happened just 4 years after they started. That tells you everything about the gap between their models and reality.
An unbelievable gap. Okay, let's clarify their basic strategy again, arbitrage. At its core, what is that simply?
Yeah, simply put, arbitrage is about trying to make risk-free profit by exploiting tiny price differences between identical or very similar assets. You hedge your bets, aiming to be market neutral, meaning you don't care if the whole market goes up or down, just that the small price gap closes.
And that was LTCM's bread and butter, especially early on.
Exactly. Their main game was bond arbitrage. They'd find, say, a brand new 30-year U.S. Treasury bond yielding 7.24%, and an almost identical one issued 6 months earlier yielding 7.36%.
A tiny difference.
Minuscule. But they'd buy, go long, the higher-yielding one, and sell short the lower-yielding one. They're betting that tiny spread will eventually disappear as the bonds become effectively identical, and because the profit on each trade is so small.
They needed massive leverage to make it worthwhile.
Precisely. They did other things, too, like equity arbitrage, betting on the price difference between, say, Berkshire Hathaway A and B, shares converging to its proper ratio. But bond arb was the core.
Okay, so that's the genius part, the core strategy. But you mentioned earlier they strayed from that into merger arbitrage.
Right. And this is where they really went off-piste, outside their circle of competence. Merger arbitrage sounds like arbitrage, but it's really not the same kind of sure thing.
How does it work?
So a company announces it's buying another company, the target. Merger arb involves buying the target company's stock after the announcement. The bet is that the stock price, which usually jumps but not all the way to the deal price, will rise that final little bit when the deal actually closes.
Okay, sounds reasonable, but where's the catch?
The catch is, what if the deal doesn't close? Regulatory issues, financing falls through, whatever. If the deal breaks, that target stock price can absolutely plummet.
Ah, and if you're using huge leverage.
Exactly. A broken deal could be catastrophic.
Right.
And LTCM got into this partly because those bond arb spreads were shrinking, and partly, you have to assume, because of that hubris. They thought their Midas touch applied everywhere.
Which leads us perfectly to that famous phrase, picking up pennies in front of a steamroller.
It's a powerful analogy often attributed to Nassim Taleb, but certainly something Buffett also warns about. Buffett asks, why do smart people risk what they have and need for something they don't need? It's crazy, like playing Russian roulette for kicks.
And the underlying principle is about asymmetry, right?
Absolutely. You want activities where your potential losses are limited, but your potential gains are ideally unlimited, or at least very large. Think about buying a stock.
Yeah.
The most you can lose is 100% of your investment, but the upside could be many, many times that.
Versus the steamroller.
Right. The steamroller trade is the opposite. Small, limited potential gains, the pennies, but the potential for catastrophic total loss, the steamroller. Like, say, driving recklessly fast to save 5 minutes on your commute. Tiny gain, potentially infinite loss.
And LTCM's trades, especially as they evolved, fit that steamroller profile.
Increasingly, yes. Scholes himself described the fund as like a vacuum cleaner, sucking up tiny nickel and dime profits everywhere. But looking back, it was much more like constantly bending over to pick up pennies while ignoring the giant steamroller bearing down on them.
Because their core problem was
Their ideas, their bets on these tiny spreads closing were usually right. Almost always, in fact. But the problem is, being right 99 times out of 100 doesn't matter if the one time you're wrong, you get completely wiped out.
As Lowenstein quotes someone saying, an outstanding record becomes quite a mediocre one when it is multiplied by 0.
Exactly. That one loss negates all the previous wins.
And it seems like their own intelligence, their egos, blinded them to that possibility.
It really does. It goes back to that other Buffett insight.
Yeah.
It's better to have an IQ of 120 and think it's 110 than to have an IQ of 150 and think it's 160. Overestimating your own genius is dangerous.
LTCM definitely thought their IQ was a 160 plus. They flew incredibly high from 94 to 97.
But in 98, they flew way too close to the sun, and the wings melted.
So wrapping this up, this deep dive into LTCM really hammers home some critical lessons. We've got that deadly cocktail of leverage and illiquidity. Huge warning sign.
A major one.
We've seen that investing, despite the math wizards, is not a precise science. Models are tools, not crystal balls, and they can be badly flawed.
Especially when it comes to predicting human behavior under stress.
Yep.
Fat tails are real.
Then there's the danger of straying outside your circle of competence, especially when the easy money dries up. Chasing returns can lead you down risky paths.
Yeah, sticking to what you truly understand is crucial.
And finally, maybe the biggest lesson, avoiding that steamroller. Understanding the asymmetry of risk and reward. Don't risk catastrophic loss for tiny gains.
It seems so obvious, but it's so easily forgotten in the heat of the moment or when blinded by success.
What's maybe most sobering, though, is how little the broader financial world seemed to learn from LTCM. Just a decade later, we had the 2007-2008 global financial crisis, driven by many of the same factors: leverage, complex models nobody understood, hidden risks.
It really is tragic. It underscores that old saying, it is not the teaching that is the most important factor. It is the learning.
Yeah.
Hearing the story isn't enough. You have to internalize the lesson.
Which brings us to our final thought for you, our listener. There's that quote often attributed to Einstein, maybe wrongly, but it fits. Insanity is doing the same thing over and over and expecting different results. Looking at LTCM and then 2008, how can you make sure you're actually learning from these financial histories and not just, well, hearing another crazy story? Something to think about.